Hello, from LPL Financial. Welcome to The Talking Point. I'm your host, Quincy Krosby.
Good morning, everyone. This is Quincy Krosby. It's The Talking Point. It's Monday morning, October 2nd. The market isn't open, but it has turned red. That is to say, the futures market has turned red as the 10-year Treasury yield has inched higher. It's now above 4.6%. Let me get to that in a minute. We all know that, quote unquote, crisis averted. The can is being kicked down the road. We will not deal with this for a month plus. But the hope is, and yes, this is the hope, hope springs eternal, that they can come up with something before the actual date and come up with something that doesn't cause this last minute gasp. You know, it's interesting because it's as if the country has just become immune to these last-minute, drawn-out dramas, and I think that's the case, over the weekend. So, in any event, the government is open. We are all back to work. The airplanes are running, and so on. But keep in mind, we still have to deal with this, and more than that, at some point, we've got to deal with these excessive debt loads that the U.S. has. That's time for another call, not today. But today I want to go over that Treasury yield, the 4.6. Now, a lot of it has to do with the following. If I was very worried about the possibility of the government shutting down, I would go in and buy treasuries. That's my safety. And not just here in the U.S. Buyers would come in from all over because obviously if we shut down, it affects the rest of the world. And so you go in and you buy treasuries as a safety net. Now, crisis averted, I'm going to unwind my holdings, meaning I'm going to sell them. And therefore what happens is the yield goes up. So let's remember that. If I'm going to sell something, the yield is going to go up. If we have more buyers coming in, the yield goes down. That's why the auctions that we have, and why I sometimes talk about that on this call. We watch to see how much buying of our treasuries, because the more that we see money come in to buy the treasuries, the more the yield goes down. This is why, just as an asterisk here, why quantitative easing, when the Federal Reserve does it or any other government does it with their respective bonds, when they go in and they become huge buyers of our bonds, the yields come down. So keeps that in mind. When I am not buying, I'm going to auction and we don't have buyers, the yield has to go up in order to attract buyers. That's, again, why we pay attention to those auctions, particularly in periods where we're worried. So, again, the yields did not climb higher this morning because of inflation, any data that came out that showed that inflation is rising. It was an unloading of the treasuries that I bought. I'm just giving you an example, that I bought because I was worried. So let's keep that in mind and let's watch to see this week where we are with the Treasury yields by the end of the week. This is an incredibly important week. I say that every week, I know that. But when we're in periods of transition, periods in which the market is trying to figure things out, every single week seems to have something that can move the market. So last week, we had the Personal Consumption Expenditures Index, known as the PCE, the Fed's preferred inflation reading. Yes, it came down. It moved in the right direction, except core. Core did come down. It came down below 4%. And by the way, psychologically, that's important. But it's still high at 3.9%. It shows that the stickiness is untangling, but perhaps at a slower pace than the Fed wants to see. But nonetheless, the Fed had to be pleased with it. But I'm just saying that I don't know how much patience they will have watching that core come down, and at what pace will it come down. Needless to say as well, oil prices remain high. Food prices are coming down a bit, but they are still high vis-a-vis last 2 years ago, I would say, before the crisis. So let's keep our eye on what we see this week, because this week is extremely important. Let me go over it. Let me go with the most important this week, and that's on Friday. It is the payroll report. Now, this is key because, again, wages have been an issue, and the market has been concerned that the more that labor is in control, so to speak, the more that they could put pressure on wages. This is why last month we saw the participation rate pick up. And that was important because in the labor market, the more people that come in, the more the owners, the employers, have more choice. And in an environment like that, particularly as the employment number, the headline employment number, came down, it was still solid, but it came down. What happens is, if I'm the employer, you know what? I may not have to cave to your demands. I have a much bigger pool to choose from. So this Friday, we're going to watch to see the participation rate. Does it continue to grow? Obviously, we're going to pay attention to the unemployment rate at 3.8% to see if it rises. And also, obviously, we want to see how many new jobs are being created. The expectations are, and this is what we call consensus estimates. This means all of the analysts that have come, and given their guidance, so to speak, about where they think it's going to be, they take an average of it. So right now, the consensus estimates on this Monday morning for Friday morning's payroll report is 170,000 new jobs created. That's down from the last report a bit. We'll see if that holds up, and we'll see what the unemployment rate is, A. We'll see what the wage growth is. Remember, we don't want to see wages move much higher. And that the reason is, just to repeat this yet again, when wages keep moving higher, keep it in mind as another input cost. All right, I have to buy chemicals for my company. I have to buy oil for my company. But I need supply from labor, and that's an input cost. And wages are one of the most important input costs in our country. So again, they're going to try to take those higher wages and pass them along to the final buyer of their goods or services, and that would be higher prices. So the more that wages can stabilize and come down, the more we expect that the companies, small business owners, large business owners, corporations, will not be pushing those higher prices. They will have to slow down that push. So we're going to pay attention to that, wages. The other thing we like to pay attention to is hours in the work week. And that's important because the more hours in the work week, it tells us that economic activity is percolating. Economic activity needs the workers to work extra hours. So we want to pay attention to that because we had seen that the hours per work week had started to inch lower. So we want to pay attention to this. It's important. And we'll also want to see the makeup of the employment landscape. Are there government workers? How many were government workers? How many went into construction? How many went into healthcare? How many went into education? And so on. We want to pay attention to that, or manufacturing. So we'll take a look at that. But that's going to be a crucial report. Again, the issue is about labor. If it starts to crack, because I want to just make this very clear, the initial unemployment numbers that we are getting, remember, every Thursday morning we look at that, the initial unemployment have been really level. They've been steady. We haven't seen a skyrocketing of folks coming in and saying, oh my God, I lost my job, because that number goes up on Thursday morning. But it has been very steady. So we want to watch that. And the reason this is important, particularly now, is if folks start losing their jobs and we start seeing it in the initial unemployment claims, what happens, and it happens very quickly, is that consumers, 68% of our economy, start slowing down the spending because you start to think, holy moly, I'm next. It's the psychology. You know, sometimes when we read the stories in the press, they make it so complicated. You know what? I put myself in that picture, and how would I react? And we all have to do that because that makes it simple, so we understand the dynamics in the market, the dynamics in the economic backdrop. So that's on Friday. So that's the big number for this week, by the way. Now, conversely, if this is a large number, not 170, but say it's 270 or even 300 new jobs, the market will be, oh my goodness, this is going to push inflation back up. So let's wait for it and then see. It may change during the week, this consensus estimates, but right now it is about 170. Today is an important day as well. And you may get this, listen to this tomorrow, not Monday. You may listen to it much later. But today on Monday, the Institute for Supply Management, the ISM, these are the people in charge of the companies that they tell the ISM, Institute for Supply Management, what's going on in terms of purchasing. These are the purchasing managers' reports, and they're very important. It will be the ISM manufacturing. Right now, the expectations are that it will still be below 50, and remember, 50 is the line in the sand. Above 50, we see expansion. Below 50, we see contraction. Now, the expectations here, however, is that it may move up, still in contraction, but move up to 48. So that, we would say, would be a bottoming process taking place because it would be coming up from 47 to 48. This is the ISM manufacturing survey coming out today, Monday, at 10 o'clock Eastern Time. We'll also have construction spending. On Tuesday, there will be the job openings report, you know, the JOLTS, job opening and labor turnover. I want to mention here very, very quickly so I can move on, and that is there have been concerns that the numbers are not reflective of the actual labor market, that there are redundancies in those job opening surveys, that employers don't pull them down when they're not interested. So we'll take it, the way it comes, and you'll hear the market talk about it. But labor turnover is important. I think that is more realistic. That is when people quit. Normally, people quit to jump to another job, mainly because they're getting more money. And that then also gives us an important picture of wages. So that's why we pay attention to this. And also, if you believe the number of job openings and you say, oh no, this survey is actually accurate. Well, if you believe that and the number of job openings start climbing much higher, that also places concern because it tells you that there are so many jobs for people to go to. They can jump here and jump there, all for more money. When it shrinks, then it gives you a picture and says, whoa, people don't have that many opportunities, and therefore this extra money that they could be paid is not going to happen because there aren't as many job openings as there were before. So that's why we pay attention to it. Now, Wednesday will be the ADP report. This is the private sector report. It does not have government. Last week, it came in lower than expectations at 150,000 new jobs. It does not, to repeat, have a direct positive correlation with the Friday number. And a lot of people make that mistake. However, we have found over the years that, and they keep changing the methodology, I should point that out, that the trajectory tends to correlate. So if it comes down, we typically may have a lower number with the Friday payroll report. But, you know, the other thing about the ADP report is it has a lot of revisions. So you'll get a number and it'll be revised downward, you know, a week later, a month later, or 2 months later, or revised up. So again, I just want to say it comes out on Wednesday, but I wouldn't bet about what happens on Friday with the ADP report. And then also, I do want to mention that on Wednesday, we'll have factory orders. And during this period, we're worried about the economy. There's more recession talk than I've seen for a while, concerns over higher interest rates, concerns over students with the loans. The student loans have to be repaid, concerns over higher gasoline prices. There's more concern right now in terms of everything having to do with the economy, and more talk about a potential slowdown coming, and even recession talk has come back, despite the fact, by the way, that the views in terms of the economy, in terms of GDP and growth for the quarter that we're in, or out of the third quarter, is still quite high. And therefore, the question is, when do folks see this slowdown coming? So obviously, they're seeing it coming in early 2024, when everything kind of hits and students don't have the student loan payments take away discretionary spending, the higher interest rates put pressure on the credit cards and so on. But we're going to have on Wednesday too the ISM service sector report. Very important, and everyone knows why, because our economy is a service sector economy. So just like in the manufacturing report that's today on Monday from the Institute for Supply Management, we're going to look at the following. We're going to look at new orders in both the service sector and manufacturing. We're going to look at hiring expectations. This is another perspective about hiring. And here's for both, for manufacturing and the service sector, we're going to look at the prices paid. Are they going up as they have been, or are they going to stabilize? Obviously, in this kind of environment where inflation is important, we're paying very close attention to what we're going to hear. And then, that then takes us over to Thursday and Friday. But I do want to add here now, too, we also have Federal Reserve speakers out, including Chairman Powell. So the market wants any clues that we have about what they see about inflation and what they intend to do. More and more, we're hearing a commentary that the Fed wants to stay higher for longer. We all know that. But whether or not the Fed is done. This is obviously going to be crucial for the market, obviously. But the question is, will they tell us, or will they just, plan on skipping meetings or pausing, you call it what you want, and then the market just kind of figures it out. We have to see, but we want to hear what they have to say. I want to add, too, Loretta Mester is speaking this week. She is one of the hawks. She is highly respected, and we'll hear what she has to say about what she thinks about what the Fed should do. She is, one of the hawks that you would call her a pragmatic hawk. She's not out to just keep raising rates for the sake of it. She is concerned, as is Powell, that if they stop now, they may see a resurgence in inflation. And I'm sorry to add this word here, that you could start to see stagflation hit. And what is that? That is where the economy slows, but interest rates are high. So all of these are, part of the market scenario this week. The good news is we will be working our way out of the seasonality, and that obviously is helpful. Early October can be dicey, there's no doubt about it, but then we start moving into the sweet spot. Good news also here. Since the beginning of the year, the S&P 500 is still up 11%, even with the sell-off. It would take an awful lot for the market to just end the year, zero. It would take a complete worry, concern that the Fed just keeps going and going, right? And that's not going to happen. They are either done or they are close to done. And then it would also take a notion that inflation is just rearing its ugly head again, and it will start showing up soon. So far, so good in terms of gasoline prices. They're still elevated, but I did my own little survey. Why did I do my own survey? Because my husband demands it. That's why. He always says, what did you pay? Why didn't you go to this station or that station? And so it forces me to go out and look. And so far it's kind of stabilized. It's obviously a little bit elevated, but it has stabilized. So a lot going on in the market and all things. But remember, you're starting to hear recession talk more and more, and the term in stagflation is coming back a bit. But again, since the beginning of the year, the S&P 500 is still up 11%. And the other thing is the expectations are that for the earnings season that really will begin with the banks on October 13th, that it may be a very solid earnings season, which would be great. The market needs this. The market needs something to focus on. Earnings is always helpful. And because of the sell-offs, I must add here, the valuation on the S&P 500 has come down. So forward earnings on a 12-month basis is just over 17 times, down from about 20 times forward over the next 12 months. So all of this, let's keep it in perspective and let's keep it simple. That's the idea. Keep it simple, because we can get overwhelmed with all the things that the market has to worry about. Believe it or not, right now the market is focused on that 10-year yield. And in terms of the futures market, which is still red, not figuring out that it was not an inflation number that hit. It is just unwinding with my Treasury holdings, because I really thought that we were going to have that slowdown. I'm not, or the shutdown in the government. I'm not speaking for me personally, because believe it or not, I told a reporter when he asked me, Quincy, do you think it's going to happen? And I said, you know what? This is one time. I don't think it's going to happen. I think there's going to be tremendous pressure, believe it or not, even from the Republicans going to the caucus, the 7 holdouts, the much conservative, the ones who say, wait a minute, when are we going to deal with the debt? When are we going to do something about the budget? And their view is, why do we keep just forgetting about it and not doing anything about it? You know, they have a point, but by the same token, the notion is that let's deal with that, because it is important, and we'll deal with it, but let's try to keep the government open while we deal with that. So let's move on for this week. Thank you for listening. Have a very good week. We'll be back next week. Goodbye.
This material was prepared by LPL Financial. It's for general information only and is not intended to provide specific advice or recommendations for any individual. There is no assurance that the views or strategies discussed are suitable for all investors or will yield positive outcomes. Investing involves risks, including possible loss of principal. Any economic forecast set forth in the podcast may not develop as predicted and are subject to change. References to markets, asset classes, and sectors are generally regarding the corresponding market index. All indexes are unmanaged and cannot be invested into directly. Index performance is not indicative of the performance of any investment and do not reflect fees, expenses, or sales charges. All performance reference is historical and is no guarantee of future results. All information referenced in the podcast is believed to be from reliable sources. However, we make no representation as to its completeness or accuracy. Securities and advisory services offered through LPL Financial, a registered investment advisor and broker-dealer, member FINRA and SIPC. Insurance products are offered through LPL or its licensed affiliates. To the extent you are receiving investment advice from a separately registered independent investment advisor that is not an LPL affiliate, please note LPL makes no representation with respect to such entity. If your financial professional is located at a bank or credit union, please note note that the bank or credit union is not registered as a broker-dealer or investment advisor. Registered representatives of LPL may also be employees of the bank or credit union. These products and services are being offered through LPL or its affiliates, which are separate entities from and not affiliates of the bank or credit union. Securities and insurance offered through LPL or its affiliates are not insured by the FDIC or NCUA or any other government agency, not bank or credit union guaranteed, not bank or credit union deposits or obligations, and may lose value.